Hello everyone and welcome back to my channel. In today's video, I will show you one of the patterns that I personally use to trade and analyze the markets. This pattern is also ICT's favorite. He calls it ICT Pattern number 1, or a fair value play, or the actual optimal trade entry. This pattern really is a game changer for identifying high probability trades, and by the end of this video, you will know exactly how to trade it. Before we dive into the pattern, I want to give credit to my mentor, the Inner Circle Trader, or ICT. His teachings on smart money concepts have completely transformed my trading, and I highly recommend his YouTube channel for anyone looking to master the markets. This video will be based on the pattern he talks about in his 2017 private mentorship core content month 12. If you want to check out his video about this pattern, it is the video number 4 of month 12 ICT core content lessons. Now we can dive into the lesson. First, I want to revisit what trading in its simplest form actually is. Like we have learned in the previous video, trading in its simplest form is just a pattern recognition numbers game. We use market analysis to identify patterns, define the risk, and determine when to take profits. The trade either works or it doesn't. In any case, we go on to the next trade. It is from this definition that we can construct the arrow, which is portraying the process of trading. We start with a condition, a rule that, if true, allows us to proceed to the pattern recognition stage of trading. In other words, when the demanded condition is present in the marketplace, we proceed to hunt the pattern or setup of our choosing. Once the pattern presents itself in price action, we proceed to the execution. We now know when and where we will enter the marketplace. We know where our stop loss will be, which allows us to define the risk. We also need to know where we will take profit. After that, the trade either works or it doesn't. In any case, we go on to the next trade. Now, we will dive into the most important part of the process of taking the trade. The most important part is the condition. It is the rule that, if present, allows us to proceed to the pattern recognition stage of taking a trade. The condition that I set for myself before I can look for the entry pattern is that I know where price is likely to trade to next, on the higher time frame. In other words, I know what my draw on liquidity is. That means that I have identified either an old high or an old low and/or an inefficiency above the market price or below the market price to where price is likely to trade to next. This gives me the higher time frame directional bias. Once I know where price is drawing to, I'm allowed to take all of the patterns that present themselves in that higher time frame direction. If I can discern where price is likely to trade to next on the higher time frame monthly, weekly, daily, and/or 4-hour chart, I can proceed to the pattern recognition stage. I need to wait for a clean higher time frame directional bias or I have no trade. I sit on the sidelines. To prove my point that trading with a higher time frame bias is the most important aspect of trading, I included some snapshots from different trading books. The first 2 snapshots are from Mark's book Trading in the Zone. He states that the lowest risk trades with the highest probability of success occur when you're buying dips support in an uptrending market or selling rallies resistance in a downtrending market. Let's say that you have chosen a precise way of identifying support and resistance patterns in a 30-minute time frame as your edge. The rule is that you are going to take trades in the direction of the major trend. That means if the trend is up on the daily, you're going to look for a sell-off or a retracement down to what your edge defines as a support on the 30-minute chart. That is where you will become a buyer. In this video, I'll show you the exact edge that I use to identify support and resistance. I will also give you the detailed list that I follow to determine the higher time frame directional bias. That way, you will have everything you need to take the lowest risk trades with the highest probability of success. The following snapshots are from Larry Williams' books. For those who may not know who Larry Williams is, he won the year-long World Cup Championship of Futures Trading with an astonishing 11,376% net return. In his book, Long-Term Secrets to Short-Term Trading, he states that the ideal sell pattern would be looking for an intermediate-term high that is lower than the prior intermediate-term high. This pattern clearly tells us that the trend of the market is down. Thus, the formation of the lower intermediate-term high should carry the momentum on the longer-term timeframe. In the second book, he presents the rule that states that we can only assume that the commodity is bullish and expect higher prices if and only if the 10-week moving average is going upwards. We can clearly see that he also demands the condition of a higher timeframe directional bias before he looks for the pattern of his choice. Here are my bullish conditions for determining higher timeframe directional bias. First, I pick a market that I'm looking to trade. Then I demand that the bullish seasonal tendency is currently present. After that, I proceed to the top-down analysis. I start with the monthly and then I go to the weekly, daily and 4-hour chart. I know the present trading range and look at where have we recently traded from. After that, I determine the institutional order flow. I note all of the PD arrays in the present trading range. If down close candles are supporting price and/or price has recently reacted bullishly on a discount array, for instance, price has a sharp rejection after trading below an old low, institutional order flow is bullish. When higher timeframe order flow is bullish, carry higher timeframe PD arrays to intraday charts, to 1 hour, 30, 15, 5 and 1 minute charts. If the above conditions are not true or not clear, the higher timeframe is neutral. Wait for opposing conditions to be true, or wait for the above conditions to form. Do not do anything for now. Once bullish institutional order flow is determined, look at the COT report. Are commercials net long or net short? Refer to commercials net hedging program, last 12 months. Are we above or below the zero line? If commercial hedgers are in a long position, look for intermarket relationships to confirm the long trade. Look for positively correlated assets to support your long trade idea, and look for negatively correlated assets to mirror the long trade idea. If this is not true, do not do anything for now. If intermarket analysis supports the long trade idea, you can proceed to the pattern recognition stage. Here we have the bearish conditions. They are the same as bullish conditions, just reversed. So we will proceed to the pattern recognition stage. But before we do, if you would like to learn the bearish and bullish conditions, I recommend going through the core content lessons. Now we have finally made it to the part for which you are here for, the pattern recognition stage. After we get the bullish condition, meaning when the higher time frame monthly, weekly, daily and/or 4-hour institutional order flow is bullish, only then can we hunt for our pattern on the intraday charts. Now let's look at the ICT bullish pattern number 1, the internal range liquidity or fair value play, or the actual ICT optimal trade entry. The bullish pattern forms when price reacts from higher time frame discount array. The impulse swing creates a fair value gap near the swing low. A short-term low forms in the market structure and fails to rally higher after relative equal highs or higher high is formed. Price then retraces down into the fair value gap and under the short-term low that was formed after the initial impulse swing formed. Sell stops are triggered. Smart money uses offset accumulation to pair long entries with a sell stop rate. Discount entry. Why is this pattern so good? Because you have 4 confluences. First, price retraces into the optimal trade entry, into the 618, 705 and or 786 level. Optimal trade entry levels have to be overlapping with the fair value gap and/or the bullish order block. Price also takes out the sell-side liquidity pool, and consequently, you catch the intermediate term low before it forms. In the snapshot from Larry's book, you can see that the best buying opportunity occurs when we are forming an intermediate term low higher than the last intermediate term low, telling us the intermediate term trend is up. If you still aren't convinced about this pattern, I recommend that we look at some real examples. This is the 4-hour gold chart. We can see that price takes out sell-side liquidity and trades into the optimal trade entry, 705 level, as well as to the middle of the fair value gap. After that, price quickly rallies to take out external range liquidity. This is the same setup as on the previous slide, just shown on the 1-hour chart. As we can see, price trades into the 1-hour fair value gap and the 1-hour bullish breaker block, which sends price higher. The breaker is part of the ICT second pattern that we will cover in the next video. Here we have the daily chart of platinum. We can again see that price trades into the 618 fib level, takes out the sell-side liquidity pool and fills in the fair value gap, as well as trades into the daily bullish order block and the propulsion block. Price again immediately explodes higher and takes out daily relative equal highs. These were the bullish patterns, and here we have the bearish pattern in great detail. Because it is just a mirror image of the bullish one, I recommend that we go to the real market examples. Here we have the first bearish example. This is the 4-hour chart of the Australian dollar. This setup was absolutely picture perfect. We see price trades directly to the optimal trade entry. To the consequent encroachment of the fair value gap, it touches the 4-hour bearish order block and breaks lower to take out external range liquidity. The next example is a bullish setup in the bond market, to show that this pattern is absolutely universal and that it works in all traditional asset classes. We can see that price again trades to the optimal trade entry 705 level and into the daily fair value gap as well as the daily bullish order block. After that, price rallies higher, has a little retracement, and after that explodes higher to take out external range liquidity. Here's the 1-hour chart of the same setup we just looked at on the daily chart of the bond market. This pattern is universal. It forms on all time frames. The higher the time frame, the more significant it is. And once you spot it on the higher time frame, you can drop to the lower time frame and look for a fractal of it to trade from. Here we can see that the same pattern occurred on the 1-hour chart at the same time as we expect price to react bullishly on the daily chart and take out external range liquidity. This is as good as this setup gets, as we can now take a trade with a super tight stop loss and take our profits at daily targets. We can see that price is still inside the daily optimal trade entry, so we can take the 1-hour setup. Price trades into the 1-hour optimal trade entry as well as the 1-hour fair value gap. It also takes out 1-hour sell-side liquidity and trades higher after that. Now you know what the pattern looks like, but before you can take the trade, you need to know how you will execute. You need to define the risk and you need to decide where you will take profits. The snapshot is from Mark's book Trading in the Zone. I wanted to highlight the importance of having rigid variables to know exactly when you can execute your trade. The pattern you learned in this video is universal. It can be seen on any time frame: monthly, weekly, daily, 4-hour, 1-hour, 30 minutes, 15 minutes, 5 minutes, or 1-minute charts. If I see this pattern on a higher time frame chart, I start reducing it down into the lower time frame charts. I look for the fractal of it in the smaller time frame. Because the pattern is a formation of many confluences, you have multiple entry options that you can pick and choose from. The first option is to place a limit order at the high of the fair value gap. The second option is to place a limit order at the bullish order block. And the third option is to place a limit order at the optimal trade entry levels, either at the 618, 705 or the 786 fib level. Or you can opt for my personal favorite, the sniper entry, which is a refined entry. Price trades into the fair value gap and or a bullish order block and or one of the optimal trade entry levels. After that, look for the fractal of the pattern on the lower time frame and enter it there. Here's another example of a bullish pattern on the 4-hour chart that we will break down into the lower time frames and look for the fractal to execute our trade from. Again, price takes out the sell-side liquidity pool and trades into the 4-hour order block as well as the fair value gap and the optimal trade entry. After that, it sharply rallies to take out external range liquidity. Here we have the same setup just on the 1-hour chart, and we'll drop down to the 5-minute chart and look for a fractal of this setup there. Before we do that, here we have the entry options. Entry option 1 is to take the trade at the high of the fair value gap. Entry option 2 is to take the trade from the bullish order block. And entry option 3 is to take one of the optimal trade entry levels. And here we can see the lower time frame 5-minute chart fractal entry option. It is important to note that we don't have to wait for the whole setup to form, since you're trading the higher time frame for our pattern. We can take a trade as soon as we see that price takes out a short-term high and that we get a fair value gap that converges with the higher time frame premium array. That is why we would put the limit order to buy at the fair value gap high as soon as this candle closes. This will be our first entry point. After that, price rallies, takes out a short-term high and retraces back into the range. It is important to note that this doesn't always happen when we are trading the fractal of the higher time frame pattern. Usually it rallies higher from here. But in this example, price fills in the 5-minute fair value gap. Look at how bodies of the candles are respecting the low of the 5-minute fair value gap. Price also touches the consequent encroachment of the 1-hour fair value gap and rallies higher. This would be our pyramid entry. We get one last touch of the 4-hour and 1-hour fair value gaps, and after that price climbs higher. And now we will look at the bond example from earlier in the video. Here we see another example of the lower time frame fractal entry option. The setup is based on the daily chart, but we refined it to the 1-hour chart to get an optimal entry point with a super tight stop loss. We will return to this example when we will cover targeting. With this, we conclude the pattern recognition stage. That means that after our condition is present on the higher time frame, we can start hunting for our pattern on any time frame of our choosing. The second we spot the pattern, we proceed to the execution stage of taking the trade. We decide where we'll put our limit orders to enter the trade. Even more importantly, after we spot our pattern, we now know where our stop loss will be. I always put my stop loss under the impulse swing low or under the lower time frame key low. After we define our entry point and our stop loss, we can now define our risk. You need to define what your maximum risk per trade will be well in advance, and never risk more than that in one 20 trade sample size. The last part of the trade management stage of taking a trade is defining where we'll take profits. It is a must that we define where we'll take profits before we open the trade, as once we are in the trade, it is easy to get emotional. The key principle of taking profits is to take profits as the market makes money available to you, as well as to scale out of winning trades. How to take profits? It is best to divide your position. Split your position into thirds or quarters and scale out as the market moves in your favor. It is important to lock in profits to experience a carefree, relaxed state of mind. And for the final exit, Look for significant highs or lows, or in other words, higher time frame liquidity pools. I personally look to take my final profits above, below previous day's highs or lows in the last 20, 40 and or 60 trading days, at old weekly highs or lows and at old monthly highs and lows. And I also use swing projections, as explained in a snapshot from Larry Williams' book. I place limit orders just below or above these levels. Now that we have the rules for our entry points, where we will put our stop loss, and where we will take profits, we can look at some practical examples. Like I mentioned before, we will take a closer look at the bond market example. We will use the entry option number 1 and we'll put the limit order at the high of the fair value gap. We will put our stop loss below the impulse swing low. This would look like this. And for our take profit, we can use the higher time frame daily chart, as that is where our parent setup formed. The low-hanging fruit target would be to target daily external range liquidity. That target would yield us a 10.85 risk-to-reward ratio. And if we would want to take it a step further, we could use the method from Larry's book, where we take an intermediate term high and the intermediate term low and project the symmetrical price swing above the marketplace and take our final profit there. If we were to use these methods, the setup would yield us almost 23 risk-to-reward ratio. At that point, the trade either works or it doesn't. In any case, we go on to the next trade. It is important that you trade your system exactly as you have designed it. Commit yourself to trading at least the next 20 occurrences of your edge. Not just the next trade or the next couple of trades, but all 20, no matter what. Only that way, you'll be able to measure performance, start thinking in probabilities, and build confidence, which is paramount to sticking to your trading strategy. You cannot deviate, use, or be influenced by any other outside factors, or change the variables that define your edge, until you have completed a full sample size. As a technical trader, you only need one setup or pattern to trade on. Trying to master multiple patterns early on leads to inconsistency, confusion, and jumping from one trading strategy to another. Focus on one trading pattern only. That way, you can start thinking in probabilities, build confidence, and measure performance. The key takeaways of this video are that condition is the most important part. If condition is not present, there is no trade. After that, pattern recognition is key. Trading is a numbers game of patterns and probabilities. Focus on identifying and mastering one pattern to build consistency. Risk management is crucial. Always define your risk per trade and stick to your stop loss levels to protect your capital. Think in probabilities. Trade in sample sizes of 20 plus trades to measure performance and build confidence in your trading strategy. Remember to stay disciplined. Commit to your trading plan and avoid deviating from your strategy based on emotions or external factors. It is important to practice. Apply the pattern in a demo account to gain experience. Track your trades, review your performance, and refine your strategy based on the results of 20 plus trades. Just stay consistent. Focus on mastering this pattern before adding other setups. Consistency is the foundation of long-term success. Thank you for watching. I hope this presentation on ICT Pattern number 1, internal range liquidity, or what he calls it, fair value play, has provided you with valuable insights to enhance your trading strategy. Remember, trading is a journey of continuous learning and improvement. If you found this video helpful, please like the video, comment if you have any questions, I'll be happy to answer them, subscribe to our channel, and hit the bell icon to get notified whenever we upload new content.